Welcome back. We've got the market, which is looking good, 60 points higher, 18,662. Sunil Koul is Executive Director at Goldman Sachs. He's joining us right now to talk about markets and future potential returns. Sunil, good morning. Great to have you with us here. The Indian stock market needs little by way of advertisement. The performance track record talks about, I think, does the job very well. You highlight some of the performance in your report when you write that the BSE 200 group of stocks has, over the last 20 years, delivered 16% rupee return on a CAGR basis. And that is, far higher than what the MSCI emerging market group of stocks have really returned. You also say that, the number of multibaggers over the years in India has been far higher than elsewhere, anywhere in the world. So how should we look at this? It's a market which has historically done very well, rewarded very well, relative to other markets, but is it also a high bar, high starting point? What should we draw from the analysis? What's your view?
Thanks, Prashant. I think it's an interesting analysis, actually, because we looked at 10 different markets across EM and DM, close to like 7,000 odd stocks. And what it showed is that historically, India has delivered the highest proportion of multibaggers. The way we define it is basically look at stocks that have generated more than 10x returns over a 5-year period over the past 2 decades. And India actually had more than half of the stocks from CNX 500, so close to 269 stocks that were multibaggers. And in fact, the median return for India was around 24x, so 24 times your initial investment. So very strong sort of potential for alpha picking in the market. And I would say that the main reason for this is that if you look at the Indian economy, obviously it's a large domestic economy. The economy itself has grown 7-fold over the last 2 decades, right? And so I think there is a large headroom for companies to grow, and companies that are sort of delivering efficiently are able to capitalize on that growth, which is partly the reason why we find so many multibaggers opportunities in India. And what we've also wanted to make a case in the report was that it's not just the alpha, but even if you're holding India as a beta trade, it has delivered very substantial returns over a longer period of time. In fact, if you look at the last 10 years or so, India only has had one down year. EM has had 6 down years in the last 10 years. If you go back last 20 years, India is down only 3 years in a row, far lower than what the EM index has given you. So I think people generally understand that, and that's why there's a lot of investor appetite in terms of putting longer term money into India.
Sunil, morning. Rima here. I wanted to dive straight into the sectoral calls that Goldman has. The greatest returns are made when market participants are at their pessimist best. Right now, the sector, which is in doldrums to some extent, is technology. Would you rethink your underweight call on technology?
We have been more geared towards the domestic cyclicals part of the market for a while. That call has worked very well for us. You're right, Rima, the technology stocks have underperformed. The sentiment there continues to be soft, but we still think that the overall growth opportunities still lie within the domestic cyclical sectors. That would include banks, that would include the broader manufacturing sector, industrial, cement, that would include some of the consumption areas. So relatively speaking, within the market, we are still a little bit more cautious on the export-oriented names, both pharma as well as tech.
Sunil, taking that point forward, you in your report write that you like sectors or other themes, right, which have, as you say, explicit government support. Make in India, PLI schemes, etc., for example. Can you narrow that down a little bit and talk to our viewers about what you like in that theme, within that theme?
Yeah, we actually have written extensively about the broader Make in India theme and in the specific PLI sectors, in the 14 subsectors it has been rolled out earlier this year, including with some of our sector analysts. But I would say the way to sort of categorize or that theme would be into 2-3 broad buckets. There's obviously the EV transition theme or the self-sufficiency theme, which fits into some of the subsectors there. There is the import substitution bucket, which has some of the electronic hardware, the white goods in there. The ENC companies fall into that. So I think that would be another pocket. There are also some of the traditional export areas, including kind of textiles, which all follows in that. I think the way to kind of look at these sectors either is into these buckets, but also the way to differentiate would be look at areas or sectors wherein India already has shown some scale or has already got some scale. I think mobile phones would be a good example. You don't need large capex investments to begin with. You don't need a large hand-holding from the foreign entities. And in that case, we think it's it's more likelihood that you'll be able to generate meaningful returns over the next 2 to 3 years. On the other spectrum, I think there are sectors wherein you need large capex investments as well as some technology transfer, whether it's semiconductor space, whether it's some of the energy transition, EV bucket. That we think is a strong, compelling secular theme, but that will take time to play out. So I think it's a function of where can you get the results much more quickly in the next 2 to 3 years versus where the theme looks very compelling, but it might take a little bit of time for results to show up.
Not often, Sunil, are the winners of the last decade the winners of the next decade. Since you've analyzed all the big wealth generators over the last, across, BSE 200 companies, can you tell us which of the themes, some ideas on the stocks where the best is behind, and these may not be the wealth generators going ahead?
Yeah, Rima, I think one of the ways to kind of look at it is what are the common traits that are there in India, in other markets that have held across time, across cycles. As I said, we sort of looked at it over the past 2 decades. And in general, not surprisingly, it would be companies that are growing at very rapid rates, both in terms of top lines, bottom lines. So companies that have very efficient capital allocation, so high return on equities, high return on invested capital. Generally, if you want very strong compound returns, you need to pick companies a little bit early, so starting valuations should be more reasonable. And then most of these companies tend to be sort of small, mid-cap in size, more domestic in nature, a little bit more sort of promoter holding to start off. I think those are kind of the common traits we found. I mean, this is not obviously includes everything, but we think all these 269 stocks we identified have sort of either sort of most of these characteristics. Right? So I think if you sort of use the same template going forward, the companies could change, the sectors mix could a little bit change, especially you got a lot of new economy sectors now coming in. But the main criteria I would say is similar characteristics, which is like you need to identify companies that are growing very rapidly or are expected to grow very rapidly over the next sort of 3 to 5 years. Where your return on capital is quite efficient, more than 15% is what we are sort of penciling in. And valuations is one thing which we are not able to find obviously market cheap at this point, but at least we are incorporating some valuation discipline in our screens, and we are looking at stocks that at least have sort of less than 3 times PEG ratio. So you even sort of accounting for this stronger growth, you're able to get at least a reasonable valuation. So if you have those set of companies across the domestic sectors which are growing very fast, we think that could be the potential multi-baggers. Some of them obviously fit into these sort of broader themes we talked about. I mean, there is the theme of Make in India we just spoke about. There is the digitalization theme. There is the broader theme of sort of consumption in India. So it obviously are a part of those. But also as a part in the report, we have sort of looked at 30 high growth industries which are growing more than 15% top line, bottom line over the next 2 to 3 years. So those are the sectors where to start sort of looking at some of the companies.
I want to go back to that first question, Sunil. When you look at the drivers for the returns, right, over very long periods of time, is it also the kind of market we've had, and that kind of ties in with high valuations? People say, well, the market here is always more expensive as compared to other emerging markets. India is a lot more consumer stocks. We're not a commodity market in that sense, right?
That's right.
Many emerging markets, which we usually compare ourselves against, they're large commodity exporters, which are much more cyclical in that sense, and so they go up and down a lot more. Is that an important kind of differentiator? And that is the reason why, I mean, people are generally more excited and enthusiastic about the market here.
Absolutely. I mean, look, India, as you said, the composition of the market is such that it trades like a growth stock, right? I mean, it's a large domestic economy. You get large parts in financials, consumption, domestic manufacturing. And people don't typically come to India for buying sort of metal companies or commodity intensive companies, as you mentioned, Prashant. And so there is always a premium for growth. I think in terms of valuations, the way we kind of look at India's valuations relative to the rest of the region or EM is, if you looked at, for example, back in October, we were a little bit cautious on the market because India's valuations to the broader region was almost at 100% premium. So twice, India was trading at 22, 23 times forward. The overall region was trading at 11 times forward. So you were trading at 100% premium. Fast forward, as we know, first quarter, India was the worst performing market in the region. You had some of the other North Asian markets, including Korea, Taiwan, China did very well. And so that premium has come down. And right now, India is trading around 20, 21 times forward. The region is at 13 times. So India is at a 60% premium. It's not cheap, but at least it's lower than what it was 6 months back. And so our sense is that if people can find good quality company at reasonable prices that have room to grow, that's a strategy to be in the market right now.
All right, Sunil, it's a great conversation as always. Thank you very much for your time. And, it's an interesting report and there's so much to it, right, which we can, I guess, pick up on another occasion. Some of the facts you mentioned will stay relevant for the next many years to come. Thank you very much, Sunil, for that. We'll take a very quick break here.